As crypto continues to consolidate, dip, or even crash, many people are calling for the beginning of a bear market simply because the 4-year cycle says so. But here's the problem. The 4-year cycle might be one of the most misunderstood, misguided, and most misleading data point in all of crypto. If you don't understand what it actually represents and what it doesn't represent, you risk completely misreading where we are in the bigger picture. And right now, in this moment, it is the worst possible time to misunderstand the data. And I know that sounds very dramatic, but when you zoom out far enough, it becomes very obvious what is happening right now at this moment of the cycle. And it is this: we're not in a halving-driven market anymore, and we might have never been in one. We are in a liquidity-driven market, and liquidity has been dry for years. And the moment you realize that, everything about how you think about Bitcoin, altcoins, and the current run changes completely. So hit the subscribe on the way in, and as we dive into this data and you want to make sure that you are positioned well for the current crypto cycle, click the link in the pinned comment below and get into our free trial of the CCV intelligence system. We have our proprietary risk models that help you accumulate when risk is low and take profits when risk is high without emotion. And some of the risk scores right now are pretty incredible to see. So let me get something straight right from the start of this video. The 4-year cycle didn't just end. It might have actually never existed. Through the years and through the cycles, it has looked real, it has felt real, and at the surface, it makes complete sense. Now, before I explain why I think the Bitcoin 4-year cycle theory is irrelevant, I want to show you something very important on the Bitcoin chart on the weekly. In 2014, we have the 20-week moving average cross below the 50-week moving average. From that moment, it was around 161 days to the bottom. And in the next cycle, when that same exact move happened, the 20-week below the 50-week moving average, it was around 161 days to the bottom. And last cycle, when the 20-week moving average crossed below the 50-week moving average, it was 238 days to the bottom. Right now, the 20-week moving average, the green line, has not even fallen below the 50-week moving average. That move would still need to happen. So let's suppose that it happens in maybe a month or two, and Bitcoin falls for around, let's just say, 150 days. To look at previous cycles and take a similar type of bear market move. That would still be around 200 total days of downside for Bitcoin to fall into a bear market right now. Now let me illustrate right from the beginning of this video why I do not think that is going to happen. And this will be everything we talk about in today's video. That green line that you see there across the screen is the business cycle, the PMI. Notice in this 2014 bear market, the PMI was falling. Notice in the 2018 bear market, the PMI was falling. Notice in last cycle's bear market, the PMI was falling. And it's been contracting ever since. Record breaking. But now we are getting hints with quantitative tightening coming to an end that this business cycle, this PMI, is going to start expanding. And that is what bull markets are made of. But this is also why I do not think we're entering a bear market. When you zoom out and overlay crypto with the real macro drivers, like liquidity cycles, PMI expansion, and the Fed's balance sheet and their approach to monetary policy, the pattern becomes unmistakable. Up to this moment, what people have called the 4-year cycle was really just the timing of global liquidity expansions lining up with Bitcoin halvings by an insane coincidence. Just look at the history. 2013, liquidity expansion. 2017, liquidity expansion. 2020 to 21, massive liquidity expansion. Each one lined up with a halving. But the halving wasn't the driver. It was liquidity. It was PMI turning up. It was the business cycle. So what has happened over the years and over the cycles is this. The Bitcoin halving has become this mascot. But the entire time, liquidity was the machinery behind the scenes that was really pumping things. Now, I want to make a very important note. I'm not saying that the Bitcoin halvings and everything therein doesn't matter. It absolutely does. The supply shock is real, and it's a core part of Bitcoin's long-term price appreciation. But the halving isn't the ingredient that creates bull markets and bear markets. It's just one fundamental tailwind inside a much larger liquidity cycle. So it's not like this 4-year cycle theory broke. It's that the illusion is ending because liquidity timing finally diverged from halving timing. Hence this crazy extended business cycle contraction that we're stuck in for years right now. It's record breaking. Now, right now, as we realize this, something very important is happening. As institutions are now entering, the fundamentals are changing fast. Crypto as a whole is now behaving like an asset class, not a retail experiment. Today, ETFs exist, with many altcoin ETFs lined up right now for approval. Bitcoin trades like a macro asset. Altcoins very clearly follow liquidity cycles, not halvings. Flows are algorithmic. They're not emotional. Global liquidity drives everything now. And this isn't just my view. As Wilberforce over here on X says, the difference between this cycle and the previous ones is the rise of institutional control. This is why the traditional 4-year cycle may now stretch into 5 years. He also said this: these boring phases are usually when people sell right before the breakout. And that's exactly where the market is right now. Every major crypto rally, 2013, 2017, 2020, aligned with global liquidity expansions. Every stagnation or crash aligned with liquidity tightening. The halving didn't drive the market, liquidity did. So that's the new reality. Liquidity isn't just flowing into crypto anymore. It's also flowing into AI, into equities, into tech. You and I, in this crypto game, are playing in a way bigger arena right now. And this leads us to a very important point. Quantitative tightening is ending. This is the second time in financial history that QT is ending. As you might know, the last time was September 2019, and everything was about to go vertical before COVID interrupted the entire bull market playbook. So right now, as I record this video, we are hitting that same inflection point again, but with a larger, more mature crypto ecosystem. Leo Lanza over on X said, "The critical insight. We have never entered a bear market during a liquidity expansion phase. This isn't about COVID level stimulus. It's about the directional shift from tightening to easing." Think about that. We are about to go into liquidity expansion, and Leo is saying we've never entered a bear market as we are going into liquidity expansion. That's the key. So ask yourself, which direction is liquidity about to head? Contraction or expansion? The moment QT stops, liquidity stops draining. Then it starts expanding. And that's the moment markets reprice. The PMI right now is one of the strongest indicators in my macro framework. When PMI bottoms and cycles upward, risk assets explode. So ask yourself right now, what is happening? PMI has been bottoming for years. PMI is about to turn up. QT is ending. Liquidity right now is sitting at an inflection point. So why would the market still follow a fixed 4-year halving cycle when the entire macro environment moves in these very large liquidity cycles? The timeline shifted. The halving clock is irrelevant. The liquidity clock drives the cycle now. And I think it's very clear altcoins have officially broken away from the Bitcoin halving. Altcoins are no longer tied to the halving at all. Altcoin cycles will now be driven by ETF demand, institutional rotations, on-chain activity, different sector narratives, meme coins, DeFi, etc., liquidity flows, AI adoption, L2 growth, and interoperability cycles. Ethereum, Solana, Cardano, AVAX, anything. None of them move on a Bitcoin halving clock anymore. This isn't 2013, it isn't 2017, it isn't even 2021. We are in a brand new game. It is an entirely different market. So what replaces the 4-year cycle? What exactly is happening? We are entering the first true liquidity cycle of the crypto era. Not a Bitcoin cycle, not a halving cycle, not a 4-year pattern. It's a global liquidity cycle driven by the Fed balance sheet inflections, treasury cash flows, bond issuance cycles, repo market stress, PMI reversals, even China and Japan liquidity, ETF flows, institutional rebalancing, cross-asset liquidity correlations, everything. Brand new territory. This is the new cycle. And if you really think about it, crypto is now inside the global liquidity engine, not isolated from it. So if you're out there and you're waiting for a 4-year cycle, I think you might be waiting for nothing. So what now? The cycle is tied to global liquidity, not the halving. Hunter Horsley described the psychological part of this. People believe in 4-year cycles, so they sell in 2025 expecting a down year. Those sellers cause 2025 to be a down year. And that breaks the cycle entirely. And that's a great point, because with the contraction of the current business cycle for years now, we do have that mental element where people are selling because they think that the bear market is starting. And what they think becomes behavior. Behavior becomes market structure, and market structure just happens to become the new cycle. No matter how you spin the charts, the halving clock is no longer the driver. Liquidity is. And most people still haven't realized that the game has changed completely. So as all this data presents itself to us, Bitcoin 4-year cycle theory versus the PMI business cycle, liquidity cycles, I guess the question we all have to ask ourselves is, what makes more sense and what is the less emotional data point? And then from there, we just have to manage our risk properly, whether you're selling or buying. If you found this video helpful or enjoyed the content, please hit the subscribe. And if you're a macro investor and you want to make macro decisions on the long term based off of risk and data and not emotion, hit the link below and get your free trial for the Crypto Capital Venture Intelligence System, where we have all of our risk models back there, our exit planners, and you can make unemotional decisions. I appreciate you watching. I will see you all in the next video. God bless.